Thank you very much for joining us today. My name is Eric Levinson, Head of Business Development for Vena Capital. We're excited to share our insights with you and help you gain more knowledge about how we invest in Vietnam on behalf of you and your clients. Now, obviously, 2020 has been a strange year, and we'll do our best to make sure that we share insights that are both unique and actionable. Like you, we've all been on hundreds of Zoom calls for the last 6 months, and we understand that Zoom fatigue is real. Knowing this, we decided to break our investor conference into 4 sessions, each with a tight agenda of 90 minutes. Our agenda today will introduce VinaCapital's senior management team, traditions of Vietnam, with the remainder of our session focusing on the macro environment of Vietnam today with an eye towards the future. As part of today's agenda, we'll also be featuring insights from the well-respected team at HSBC to get an outsider's view of Vietnam as well. The agenda on day 2 will focus exclusively on our Vietnam Opportunity Fund, we call VOF, and it's our flagship London Stock Exchange listed fund of over $900 million. VOF is unique in that it offers both exposure to public equities and private equities in a listed fund. Now, on day 3, we'll hear from our head of equity research, our equity and fixed income portfolio managers, and get their perspective on the local market, an update on the performance in their portfolios they manage, and some forward-looking comments. Finally, on day 4, we're going to highlight 4 sectors that are very important to the economy of Vietnam and sectors that offer us tremendous investment opportunities, both in public and private equities. We're going to hear from our team leads, our senior investors covering technology, real estate, energy, and financials. Okay, so that is what our 4 sessions look like, and we are very confident it's going to be a great agenda, and we've broken it up, and we think a way that's digestible. Now, since we cannot host you live, we still want to give you a feel for Vietnam and share with you a very important tradition in Vietnam culture. I will now transition to a very brief lion dance in front of our office here in Ho Chi Minh City. Well, I hope you enjoyed the lion dance, and that's a traditional way to kick off an important event or start a new venture. Now it is my pleasure to introduce the co-founder and CEO of Vena Capital, Don Lam. Don co-founded Vena Capital in 2003 and has been a pioneer in investing in Vietnam and bringing Vietnam to the world. Don, thank you for joining us today.
Thank you very much. Hello, I'm Don Lam, and welcome to our virtual investor conference for 2020. As many of you know who attended the press conference, there's nothing quite like being in Vietnam in person. The touch and smell and be on the ground and seeing for yourself everything that's happening here today. Of course, that's not possible this year. So instead, we have put together a fantastic program over the next 4 weeks that will give you a good idea of how Vietnam is quickly rebounding from the outbreak. And now Vena Capital is evolving to fully access to a new opportunity presented in its wake. We have a great team at Vena Capital, led by my long-term partner, Brooke Taylor, the CEO of Asset Management, and Andy Ho, the Chief Investment Officer. They and other senior colleagues will share their thought on where Vietnam goes from here and how we will continue to provide way for you, our investor, to participate in the growth of this dynamic country. As you will see, we have a busy year, notwithstanding the pandemic, and a lot more planned for the years ahead. We look forward to welcome you back to Vietnam in person next year. And without further delay, I want to introduce you to Brooke Taylor, who will tell you more about Vena Capital and our investment platform. Brooke?
Thanks, Don. Welcome everyone to the 2020 Vena Capital Investor Conference. It's a cliche, but what a difference a year can make. It certainly feels like more than a year has passed since we last gathered in Hanoi for the 2019 annual conference. At that time, much of the discussion focused on the US-China trade war and the geopolitical tensions in the Eastern Sea. Certainly, there was no mention of a global pandemic and the challenges that would then follow. But I'm forever an optimist and strongly believe there's at least one silver lining somewhere. For us, it is that Vietnam is probably a net beneficiary from the global events that have shaken us all. With the government's leadership and the support of its people, Vietnam has achieved what many countries have not been able to do. In fact, it's brought COVID under control not once, but twice since February. I urge you to take note of this achievement because it's not simply a matter of luck, but a true reflection of the character of the country and why we believe so strongly in its future. Today, Vietnam is open for business, and more importantly, it's open for investment. I hope that you'll stay with us through the next 4 weeks, and in doing so, appreciate the full growth potential that this country has to offer. If travel restrictions are allowed, and you could be with us here today, I'm sure that you would understand what we're saying, and it would be very clear to you all. Thank you. The baton on to Andy now, and welcome him to the stage.
Thank you, Brooke. As you know, Vietnam has demonstrated its ability to manage and contain the spread of COVID-19 twice, leading to increasing confidence from investors, especially domestic investors. Though we are seeing foreign investors pulling back from Vietnam's capital market this year, we think this is short-term and foreign investors will return to invest in a growing economy of 6 to 7% per annum. Having said that, we were pleasantly surprised to see domestic investors stepping in to acquire shares at deep discounts, witnessed in April and in May. This validates our view that the domestic market has depth. It just lacks sufficient investment products. We also deployed capital aggressively in April and May and have been fortunate to enjoy recovery to almost pre-COVID level. In the sessions to come, we will discuss more in depth the performance of our funds and their directions in the months and years to come. Like us, to be even more confident in deploying capital. Back to you, Brooke.
Thanks, Andy. Appreciating that this year we may have many new attendees, we thought it would be useful if we would spend some time explaining Vena Capital and our business. It'll help you appreciate the depth and breadth of Vena Capital and why we are the preeminent investment house in Vietnam. Firstly, as a quick intro, as Don mentioned, I've assumed the role of CEO of asset management business this year. I joined Vena Capital in 2007 as Chief Operating Officer and have held this role until recently. I've lived in Vietnam since 1997 and I was a chartered accountant. I was actually a senior partner with Arthur Andersen and KPMG here in Vietnam. Our mission is to help investors prosper by realizing Vietnam's rich opportunities. We understand that the full potential of this country and where it's heading. And we know how to lead our clients in the areas that offer the greatest potential for investment they want to pursue. We don't purely focus on listed equities or private equities, but we're able to give our clients exposure to any asset class or sector they desire. Under the crisis, we've been able to reinforce our mission and place even greater emphasis on delivering it going forward. As a private company, we have the luxury of being able to plan and invest long term. And because of this, during the COVID outbreak, we've been able to attract new talent and set up our firm and our portfolios for the future. Our position this time last year was strong, but we're in an even stronger position now, 12 months later. We're committed to our investors. We work hard to understand what our investors want and how we can respond to those needs. We recognize that we can only be successful if our clients are successful. We are one firm. We have a number of teams in our business, but these teams operate under one umbrella. And every individual in our firm understands their role in supporting not just their team, but the whole organization and the clients we serve. We embrace continuous improvement. We respond always by seeking to apply international standards and processes. We learn from others, and we're always ready to change things if they can be done better. We've been investing in Vietnam for 17 years. During that time, we've built expertise across all sectors, all asset classes, and all investment structures. Today, this puts us in a unique position of being able to provide investment solutions to any investor seeking exposure to this market. As a group, we've divided our business into two core teams focused on traditional and alternative asset classes. We've done this to ensure our teams remain focused on the needs of the different clients and assemble the different skills that are necessary to provide the services. Within these groups, we have 6 specialist teams focused on public and private equities, fixed income, real estate, venture capital, and infrastructure and energy. I appreciate that private equity is usually viewed as an alternative investment, but given the unique portfolio of VOF, we put this team in our traditional business group. This diagram shows we have experience across all types of investment structures, whether mutual and closed-ended retail funds, sub-advisory accounts and investment management agreements, private LP/GP funds, and joint ventures. If we look at the makeup of our AUM, then you will see we have significant investments across all asset classes. In all asset classes, we are also a top 3 player. We appreciate the importance of investment managers being focused, and to achieve this, we have dedicated teams for each fund or asset class. But if asked, what is our specific area of specialization, we would respond, Vietnam. We believe that to fully realize the opportunities that exist in Vietnam today, our clients need an investment manager that harnesses the expertise across all sectors and asset classes. In doing so, we can give our clients access to the full range of investment opportunities in the market. Many of the best opportunities do not appear in the public markets. Our diversified range of investment mandates means that more opportunities come through our door. Business owners and advisors understand this and come to us knowing that we have the resources and expertise in our business to provide them with solutions. We make better informed investments because we can draw on a deep range of investment experiences across any given industry. For example, our expertise in real estate development and management gives us a unique insight into the listed companies operating in that sector that others do not have. Through our extensive network of relationships across all industries and sectors, we can source better investment opportunities, manage risk better, and assist our portfolio companies. I wanted to highlight our core team of department heads, all of whom are among the leading investment professionals in their given sectors. In the coming weeks, you will hear from a number of them individually, but I wanted to point out as well that as well as being exceptionally skilled and experienced, we have a diverse team made up of Vietnamese, Viet Q, that's overseas Vietnamese returning to Vietnam, and expatriate employees. This enables us to straddle the technical and cultural borders that exist when investing between different countries. We take responsible investing seriously and believe that a focus on ESG issues is essential to long-term sustainability and success. We've been signatories to the Principle for Responsible Investing since 2018 and have incorporated responsible investment into our key investment processes since that time. Recently, we've taken the important step of establishing a dedicated ESG team tasked with ensuring that ESG principles are incorporated into all areas of our business, and that the standards we adhere to are promoted to the companies we invest in. Finally, I would like to highlight the Vena Capital Foundation. Founded in 2006, the Vena Capital Foundation is the largest corporate foundation dedicated solely to improving the lives of children in Vietnam. Over the past 14 years, it's saved the lives of over 8,000 children by providing much needed heart operations, and in doing so, it's alleviated the hardship felt by many families in the most vulnerable communities in Vietnam. Thank you.
Brooke, thank you very much for your presentation and overview of our platform It's exciting to be part of a firm that has so many different ways to help investors access the opportunities of Vietnam. Our investment platform is truly one of a kind, and we're fortunate to work with so many talented investors. As I mentioned in my opening comments, today we're also featuring insights from experts who do not work for Vena Capital. We're very fortunate to have Joseph and Kokolari, Head of Asia Strategy, Chief Economist, and Dev Joshi, Frontier Market Strategist, both of HSBC, with us today via Zoom from Hong Kong. Joseph has been with HSBC for 8 years, the last 7 from Hong Kong, and Dev for 13 years, and as a strategist in Hong Kong since 2012. We're excited to have them as part of our program, and we've asked them to share their views on Vietnam, Asia, and their opportunity overall in frontier markets.
Hi, my name is Joseph Kokolari, HSBC's Chief Economist for ASEAN.
Hi, I'm Levinson Joshi, Equity Strategist for ASEAN and Frontier Markets at HSBC. We are here today to talk about our views on Vietnam. Maybe we just get right into it. Joseph, you look at ASEAN and you've been looking at it for a long time. Now, what sets Vietnam's story apart in Southeast Asia?
That's a great question, Devendra. So ultimately, what really makes Vietnam attractive in Southeast Asia is the broad-based nature of the Vietnamese growth story. So many of us are aware that Vietnam is attracting a relatively high share of the region's foreign direct investment. Its manufacturing sector is booming, but it's also the domestic retail story, which is very impressive in Vietnam. There's been relatively high growth in the services sector of Vietnam's economic engine. That's been sustained for multiple years. You see banks allocating higher share of lending to consumer portfolios. You see a relatively strong tourism sector in the last few years. So really, when we talk about Vietnam, yes, manufacturing, yes, FDI, but it's really the broad-based nature of the domestic economy. That's what sets it apart. How about for you, Devendra, having looked quite a long time at Vietnam and frontier markets from an equity perspective, what sets Vietnam apart?
Joseph, as you rightly said, and you summed up the Vietnam story pretty well. So what I'll do is probably I'll take a step back, zoom out, and if I do that, there are 2 words that come to my mind when I think about Vietnam. First of them is phenomenal, and second is anti-fragile. Now, phenomenal, let me expand a bit on it. It's not just about the delicious pho soup, but it's about the phenomenal story, the way the Vietnam has turned itself around over the last decade. I mean, you remember very well, right? After 10 years ago, after the overheating, the economy was sort of coming down, high NPLs, high unemployment, high inflation, current account deficit, you name it. And the investors were not really willing to take a look at Vietnam. And now, after 10 years, where Vietnam is probably one of the best long-term growth stories that you think is out there in the region that I cover. So I think that is what is phenomenal about Vietnam. But as I said, now the investors look to Vietnam for high returns, but risk and returns go hand in hand. So while we have been positive on Vietnam, we have kept a very close eye on the risks, on what could derail the Vietnam story. And given that it's a more FDI-led and externally growth-led economy and the market, the key risk comes from the global trade environment. And from that angle, over the last couple of years, we have seen 2 key big risks to the global growth, right? First of them is US-China trade tensions, and the second is COVID-19. But as we have seen, Vietnam has just not been able to stay resilient on the face of these risks, but in fact, it has emerged relatively better. And that is what is the definition of anti-fragile, as put out by Mr. Taleb. That's something which doesn't just stay resilient, but gets better in the face of adversity. And that's how I say Vietnam is anti-fragile. Having said that, we also need to keep into mind that Vietnam is a smaller market. It's a frontier market. It comes with its own sets of risks and issues. But in that set of the comparative peers that I look at, it has done phenomenally well. Thanks. And on that angle, I mean, from perspective of the economy and all those things, would you be able to elaborate a bit more on how the COVID-19 has changed Vietnam's relative position compared to the other economies and regions you look at?
Sure. So COVID-19 is, of course, this once-in-a-generation crisis. And it not only impacts how economies fare in the short term, but it also has long-term implications, given that it sheds light on policymaker response functions. So in this area, actually, because the Vietnamese government was relatively swift in addressing COVID-19, was able to stem the 2 key outbreaks that we've seen so far this year, it has actually boosted investors' confidence in the Vietnamese economy, particularly when it comes to Vietnam as a supply chain node. So for example, earlier in the years, We know the experience from some key Korean electronics producers that they were able to get engineers into Vietnam. They were able to restart production relatively quickly without much of a hit to activity. So I think kind of going forward in a post-COVID environment where there may be limited FDI as global capex is reduced, actually the positive example of Vietnam's handling of COVID-19 should allow for it to fare relatively well in the coming years, continuing to attract new investment. Devendra, how about from a supply chain angle and US-China trade tensions? Anything to add from how Vietnam is faring?
Yes, probably I'll approach it more from the companies and the firm side. We have done a lot of work on these supply chains in Asia and how they're reshaping and what their outlook could be. There are two things that probably we need to appreciate here. First of all, not all companies can or will move out of China. It's very difficult to replicate the scale, the expertise, the ecosystem, which means that, I mean, there will be a lot of things that you might read in the newspapers and all that, but on the ground, when the companies make decisions, it's very difficult to find all the key ingredients that are needed for supply chains to move out of China. But having said that, producing in China is expensive, so there is definitely be a movement out of China that we are definitely seeing. Second, coming more to Vietnam, as I said earlier, what we need to also appreciate is it's a smaller economy. There's only so much resources that Vietnam has. To put into perspective, if Vietnam has to absorb only 5% of the firms moving out of China, it needs to increase its capacity by 70%. And I got this data from one of my meetings with experts in the supply chains and logistics in Vietnam. And secondly, if you think about Vietnam, which is a small country, it still has 300 plus industrial parks. And they are operating at the capacity utilization of 70 to 80%. So when you meet all these companies, there's definitely a lot of demand for Vietnam, given what it has done over the last 10 years. But the issue is of supply. And this can be seen if you think about the land prices are rising. It is very difficult to find land parcels in the established industrial clusters, and the attrition rate is very high. Just to give you some anecdote, I mean, some of the companies that we have met, they were earlier very focused on employing only graduates, college graduates, but given that there is not enough labor supply available because of so many companies moving there, now they are happy to go with the high school graduates. And also some of the companies in the low margin industries, they are in fact willing to just employ farmers out of agriculture and just train them for 2 to 3 months. But even they find it very, very, very difficult. But so this is from the company's perspective. So there's a lot of demand. The resources is an issue. So I think probably over the next 5 years or so, there will be severe shortage of resources in Vietnam. But as of now, what this means is instead of what we see in the other parts of the region where the companies, the people move from urban areas, rural areas to urban areas to find employment. I think in Vietnam, what we'll see is over the next 5 years, the factories will probably have to move out into the rural areas to find more labor and employment, and this is good for the firms which benefit out of the rural consumption. And this is the story as of now, and as I said, there are probably some issues there. But then again, I mean, from your perspective, do you think Vietnam will continue to attract more FDI? Because these issues, the labor and the land resources only come into play when there is enough and sustained demand. So do you think it will continue?
So first, let's look at this from a regional perspective. So we know in the last, let's say, 5 years, Vietnam's attracted FDI to the tune of 7 to 8% of its GDP. If we look at other countries in the ASEAN region, say Indonesia, the Philippines, or even outside of ASEAN and India, generally speaking, FDI inflows don't really exceed 2%. So already Vietnam has been doing much better. But I think what's most impressive is the scope and the structure of actually FDI into Vietnam, and as a result, its export capacity. So let's say go back 10 years before the global financial crisis or around the time of the GFC, actually Vietnam had very little electronics in its export mix. And then, you know, based on the billions of dollars of investment from Korean producers, and then also increasingly other kind of upstream electronics producers, now we know that in any given month, electronics can actually dominate Vietnam's production. And that's part of the reason why exports in Vietnam have actually rebounded so much this year, because we see clear activity in the 5G space and in different types of smartphones. So Vietnam is doing relatively well. So it's that increase in value add, is that move up the the scale, which is really quite impressive for Vietnam. And I think based on the experience from the Asian tigers in the 70s and the 80s, we know that there is a networking effect and more suppliers will come on shore, and eventually domestic Vietnamese firms will also meet some of that supply chain demand. So we ultimately think that it still will be a part manufacturing driven story for the foreseeable future. How about Vietnam in terms of your equity strategy remit? How do you look at the country?
Equity strategy, the way we look at it, it's basically a combination of the risk and reward trade-off between the growth, interest rates, risk, and then you overlay a valuation framework to it. So it's pretty simple that way. Thinking about growth, as you highlighted, I mean, it's relatively better growth story, even from the short-term or the long-term perspective that we have spoken about. From the corporate earnings perspective, this market, I mean, if you look at the consensus numbers, it's expected to grow around 30% next year and 20% thereafter, which is much better than the other markets that I look at, which are still reeling from COVID-19. And, you know, we are seeing lockdowns and so on and so forth there. So the growth is definitely not better here. Coming to interest rates, globally, the interest rates are low. They are expected to remain low for some time, as we have seen. And also locally as well, the interest rates are low. We just saw recently the cut in the interest rates in Vietnam. So that is also kind of, you know, helps the Vietnam story there. But the risks, I already said, and we have spoken about being anti-fragile. I mean, especially on the relative basis, there are risks out there, but relative basis, it's better. From the corporate perspective, we know that the COVID-19 will definitely impact the P&Ls of the companies. Vietnam is no exception. So what is important to look at is basically the strength of the balance sheet, that how many of these companies in the corporate sector overall can they withstand the pressures from the COVID-19, and that is very encouraging. If I look at Vietnam from my relative angle, that in Vietnam the companies have in fact deleveraged over last few years. They have decreased their leverage, the net debt to equity, from around 55-60% to under 20% right now, and which means that their ability to service debt is much higher, and which is completely opposite in the other markets where we have seen the leverage go up. And lastly, from the valuations angle, the market rates at lower valuations than what it has traded over the last 5 years. So given these things, Vietnam is our most preferred frontier market. And so we have spoken about quite a few positives and, you know, what to look out for Vietnam. But what are the biggest macro risks for the economy?
So I think from a relative basis in Southeast Asia, one ongoing risk for Vietnam is that capital adequacy ratios, capital levels in the banking sector are relatively low by regional standards. So if you take, for example, other economies, be it Indonesia, Malaysia, Thailand, the government has been able to rely on the banking sector because of its strength. Now, Vietnam has made very impressive improvements in the banking sector in the last few years, but we know, for example, that compliance with the latest Basel II regulations, which was expected by the beginning of this year, was delayed somewhat. So it's very important that policymakers don't forget the urgency of this and that continue to work on realizing this, even if there's been delays. And that matters quite a bit, particularly in a crisis like COVID, which could lead to sharp growth in NPLs. Now, the good news is because Vietnam has handled the crisis relatively well, actually the impact on NPLs should be relatively small compared to other countries. Other risks we look at for Vietnam, one is the government's fiscal room. So Vietnam has a relatively high public debt to GDP. Fortunately, a lot of it is in the form of ODA, of concessional loans from, let's say, the Japan or the World Bank or ADB. So the structure of the debt is good, but it still is relatively high. And that means the government has limited room to provide fiscal stimulus for the economy. Another risk is some external headwinds for Vietnam. So one is, for example, the United States Trade Representative recently launched an investigation into Vietnam's trade and currency practices. And this, of course, does introduce a potential risk of tariffs being implied on Vietnam's exports to the United States, similar to what happened to China. Now, one respite for Vietnam is that, yes, if you look at the trade statistics, Vietnam's trade surplus with the US has grown quite sharply, while its deficit with China has also increased. So on the surface, this does look like some trade divergence from China to the United States. But when we actually dissect the numbers, a lot of Vietnam's trade surplus with the United States is because of legitimate investment in Vietnam. Take, for example, mobile phone production. We know that Samsung previously used to manufacture phones for the United States. China, they've shifted that to Vietnam. So based on legitimate investment. So of course the trade surplus is going to grow. But in past episodes of potential investigation, the Vietnamese government has worked with the United States, the Treasury, the Trade Representative, and they have been able to come to a solution. So we are relatively optimistic on that front that this will be worked out. How about from an equity investor perspective, in addition to what you said, any specific risks?
Well, there are a few. First of all, what we need to, when we think about Vietnam, we need to think that we need to realize there is a dichotomy between the economy and the markets. The economy is very open. It's mostly, as you said, it grows because of the FDI-led investment into Vietnam. But on the other hand, the market is very closed. There are foreign ownership limits in the market, which kind of restricts the foreign investors to go and buy what they would really want to buy. What this means is the market is, in the near term, is driven more by the local sentiment. And so basically, this is one of the key risks that you might be very positive on the Vietnam, but it's very difficult to think about if you want to make money into Vietnam from 2 to 3 month perspective, because it's basically driven more by the local sentiment. The secondly, also, as I said, market is very small. It's a frontier market for many EM investors. Sometimes it's off benchmark, and also from that perspective, it is the kind of effort that goes into analyzing Vietnam and this companies and all that, sometimes it's not very easy because the kind of resources just required to put into that. And then there are usual issues with the other frontier markets, the transparency of disclosures, the procedures sometimes in the stock market, the corporate governance in some cases is a risk as well. So there are these issues that you need to deal with with any frontier market, and Vietnam is no exception out there. Having said that, we have discussed quite a bit about what's going on in Vietnam. But if you look at Vietnam further out, over the next 5 to 10 years, where will be Vietnam?
So I think when we look at Vietnam 10 years out, I think almost it speaks to partly your answer in the last question, whereby this dichotomy in the Vietnamese economy. If you take, for example, trade statistics, much of Vietnam's trade surplus is from the foreign investor sector, while the domestic sector runs a trade deficit. I think as domestic firms start to play more of a part in the trade story, become suppliers for export-driven countries and export, of course, more themselves, you will see actually productivity in domestic firms increase. Hopefully, the government accelerates its equitization plan of SOEs, and that should allow for broader productivity growth across a broader segment of the Vietnamese economy. That ultimately will make the Vietnamese growth story much more sustainable and able to go on for multiple decades to come. So we still are very optimistic on the Vietnamese economy because of some of the factors we spoke to before, the broad-based nature of growth, but also we think that some of these structural impediments that have held back some parts of the economy as the country continues to pursue key reforms, such as, for example, the PPP law passed a few months ago, which allow more private investment in infrastructure, for example, they should help reduce these structural impediments and allow for sustained growth for Vietnam. And from an equity perspective, what can really catalyze more inflows, more foreign participation into the Vietnam story?
So as I said, clearly, the reforms, the risk that we just discussed about the Vietnam market. So as these risks get addressed, that will be helpful for Vietnam, and especially there are 3 areas that probably the foreign investors should look at. First of them is the foreign ownership limit. That's an issue in terms of investment to Vietnam. But what we have seen recently is government has passed laws on securities, enterprise and investments, and this will be effective from 2021. What this will do is it will ease some restrictions in terms of the foreigners being able to invest into Vietnam. And also the goal of this whole overhaul is to reduce the number of conditions for businesses and simplifying procedures and enhance the transparency of the market. Secondly, the SOE privatization, as you said, the market is small. We need more companies, more investment options, and the privatization process could boost the efficiencies of companies and also boost the role of the private sector in the stock market. But I think it would be probably slower than what a lot of people think, and we need to be a bit more realistic that there are a lot of reforms, policies, procedures that need to be tackled. So it will happen, but maybe slightly longer than what people might think. And third is the market upgrade. A lot of investors, they are waiting for when does Vietnam get upgraded from the frontier market, emerging market. From that perspective, Vietnam is already on the watch list for FTSE, not on the MSCI yet. So Vietnam meets the quantitative criteria that are needed for the upgrade to EM status. Trading volumes, presence of large stocks, size of the market. It in fact trades more than Philippines and Pakistan, which are already emerging markets, so to say. But more issues around the qualitative, and that comes more to the reforms part. So the issues that are cited by some of these agencies in terms of what's sort of impeding the upgrade is the foreign ownership limits, the lack of some disclosures, the lack of offshore currency market, some currency restrictions out there is an issue, and also it's a pre-funding market. Some of these issues are in the process of being tackled. And I think this is not a question of if, it's a question of when. So this will happen over the next few years. But what I would advise the foreign investors is don't center your thesis on Vietnam, invest in Vietnam around the upgrade, but on the rather than the growth prospects of Vietnam over the longer term.
Perfect. Thank you, Devendra, and thank you everybody for joining us today.
Thanks, Joseph, and thanks everyone.
Well, thank you so much, Dev and Joseph. Your comments were terrific. I'm sure the audience appreciated it. And again, you know, we really wanted to feature outside speakers, and it was great to have a team from Hong Kong with both their views on both Vietnam as well as the frontier markets and the ASEAN region. So that was terrific. Now, our next speaker, if you're familiar with Vena Capital, will be a familiar face, our chief economist, Michael Kokolari. And we've asked Michael to give his view on what it's like from Vietnam, from being inside of Vietnam, and frankly, what it's like today. Now, if you've seen Michael or if you've read his insights before from our website, what you'll know is that he's not afraid to take out of consensus views. So I know you'll really appreciate this. And then at the end, I'd encourage you to stay with us. We're going to have a live Q&A. So Michael, thank you for joining us today.
Thank you, Eric, and thank you for joining my presentation today. I'm going to be talking about a remarkable improvement in Vietnam's growth story this year. And that's in stark contrast to what's happening in most of the rest of the world. You know, most countries, the GDP, long-term GDP growth prospects and investment opportunities have really deteriorated significantly. In the developed world, these countries have accumulated an enormous amount of debt this year to deal with COVID. And in the emerging markets, investors are concerned about the capability of most EM countries to cope with COVID. So there too, investment opportunities have really deteriorated significantly this year. Now, in contrast, Vietnam's long-term growth story, long-term growth prospects have actually gotten better this year. And we think that's going to drive stock market prices and real estate prices higher. And before I get into explaining how we see that happening, I want to first pause to acknowledge that COVID is a terrible human tragedy, and we have a lot of sympathy for anyone that's been impacted by COVID, of course. That having been said, we're investors, and so we need to look at things in a very rational way. And the reality is that Vietnam's relative attractiveness as an investment destination, compared to other places in the world where you could invest your money, Vietnam's relative attractiveness has actually improved this year. And that's because in the short term, GDP growth has been very resilient, and the macroeconomy has remained very stable. And then in the long term, as I just mentioned, the long-term growth prospects of Vietnam have actually improved this year, primarily because COVID has been a very powerful catalyst to trigger a new wave of FDI into Vietnam as factories leave China. The other reason why Vietnam's growth prospects have actually gotten better this year, it's a little bit counterintuitive. You probably have seen by now that Vietnam garnered a lot of positive press and positive feedback for its handling of the COVID epidemic. So the country managed to minimize the medical and economic impact of COVID on its citizens. Now, the government deserves a lot of credit for this. The government acted in a very rational way, very competent. They took actions very early in the pandemic, and that's part of the story of how Vietnam managed to navigate COVID. But it's not the whole story. The other part of the story is the Vietnamese people, who are very conscientious, very diligent, who value social stability very much. And probably most importantly, early on in the pandemic, when the government first issued guidelines to people of the steps that people needed to take, adopt in their own lives to combat COVID, Vietnamese people enthusiastically embraced these steps. And this helps to explain how Vietnam navigated COVID. The reason I'm highlighting this is because these same characteristics that I'm just talking about, these are the same characteristics that FDI companies are looking for in countries where they want to set up a new factory. You can think of countries around the world where wages are lower than in Vietnam, where the cost of building a factory might be lower. Most FDI companies, they don't want to set up in most of those countries. They want to locate a new factory in a country like Vietnam, where you have political stability, you have social stability, and most importantly, you have a workforce where people are very conscientious and diligent, and where workers will enthusiastically embrace the guidance of their leaders, of their managers. So this is another factor that's helped to improve Vietnam's long-term growth story this year. Now, in the short term, there's a consensus that the GDP growth this year will grow by about 2.5%. There's two factors that are supporting GDP growth this year. First, there was a very sharp rebound in domestic consumption after a brief 3-week lockdown earlier this year. And the other factor that's supporting consumption is that manufacturing has been very resilient in Vietnam. Manufacturing is growing at about a 5% pace this year. That's low by Vietnam standards, but it's quite high in the context of the world. Now, you may recall from the HSBC presentation of Deb and Joseph, they mentioned that the growth in Vietnam is very broad-based. And so here you see an example of this. Growth this year is being supported by domestic consumption, but also by manufacturing. And manufacturing in Vietnam basically means manufacturing of exports. So these are two very different factors, broad-based factors that are supporting growth this year. Now, the main factor that's depressing growth this year is the collapse of foreign tourists. In the past, foreign tourists accounted for about 8% of GDP, we estimate, and that's obviously collapsed, which is the main factor that's dragging down the economy this year. This recovery, sharp V-shaped recovery in domestic demand, it's really a reflection of the incredible resilience of consumer confidence in Vietnam this year. It's been a remarkable resilience. According to Nielsen, Vietnam has the second highest consumer confidence in the world, and that's after India. Now, there's some issues about how the India number is calculated that I won't get into today, but suffice to say that to me, my view, Vietnam essentially has the highest consumer confidence in the world right now. It's not really surprising. Vietnam is always among the top-rated consumer confidence countries in the world, because we have this amazing emerging middle-class story. We have a very powerful urbanization story where people are moving to the city every year and finding a lot of opportunity. Demographics are very young. That supports confidence. Now, in addition to these factors, this year, we have an additional factor, which is that Vietnamese people have a lot of confidence in how the government has handled COVID. There's a bunch of surveys done where they ask people around the world, in most countries around the world, how do you feel about how your government has handled COVID? And Vietnam came out on top. So Vietnamese people have the highest degree of confidence of their government's handling in the whole world. And that's also helped to support confidence, which has in turn supported the strong domestic consumption that you see on this slide. And by the way, what you see on this slide, this matches the on-the-ground view. If you were to go into shopping malls, into grocery stores, into restaurants, you might be amazed at how robust domestic economic activity is in Vietnam. So it really matches what you see here. So this is the first factor that's supporting growth this year. And the other factor is quite unexpected and really quite fortuitous, and that is that Vietnam produces, manufactures, and exports a lot of what have become to be known as stay-at-home goods. Now, if you're watching this presentation right now while you're working at home, you may have upgraded your laptop computer, or if you're spending more time at home, you may have bought a new TV or purchase some new furniture to make your home nicer. And this chart, what I show is that this is data from the US, where the data is kind of relatively easily available. And I have a few different categories of these type of stay-at-home products. And you can see that there's been a surge in the sales of items like televisions as people spend more time at home. Now, a lot of these products are made in Vietnam. And therefore, it's not surprising that Vietnam's exports to the US are up by more than 20% this year. Electronics exports up more than 20%. You know, according to University of Chicago, a recent survey by University of Chicago, almost 25% of the people in the US are still working at home. And so it's not surprising that there's been a lot of demand for these type of items, and that's helped support Vietnam's manufacturing and exports. Now, to give you a fair and balanced view, I also included a graph on this chart. In the lower right-hand corner, you can see that garment sales in the US have not really rebounded. And you know, that might be because when people are working at home, maybe they don't feel that they need to buy new clothes, or you know, for whatever the reason, there hasn't been a sharp rebound in garment sales. And therefore, Vietnam's exports of garments and footwear are down about 10% this year. Now, garments and footwear still make a modest contribution to Vietnam's exports. This is a legacy because 15, 20 years ago, most of the FDI that was coming into Vietnam was in garments and footwear. So we still have some legacy contribution. Nowadays, as you heard Davin Joseph talk about, most of the FDI is really electronics and high-tech items. But this legacy is pulling down the overall export story. So you've had a surge in electronics exports, decline in garment exports, and as a result, the overall exports are up about 4% this year. That's low by Vietnam standards, but looks pretty heroic compared to a lot of Vietnam's regional peers. And more importantly, this resilient exports, driven by the stay-at-home products, has driven a surge in Vietnam's trade surplus this year. Now, last year, at this time of the year, Vietnam had a trade surplus of about 4% of GDP. This is already a pretty big number. Any trade surplus over 3% is considered big. But this year, as you can see on this slide, the trade surplus has just exploded. It's over 8% of GDP right now. And to put that number in context, China's trade surplus at the very peak was around 3% of GDP. So this is really an incredible accomplishment. You know, when I first came to this country 10 years ago, as you can see on this chart, Vietnam ran persistent trade deficits. So the idea that we would, you know, accomplish an 8% of GDP trade surplus, I mean, it's amazing. And this 8% of GDP trade surplus, which is mainly driven by the export of these stay-at-home goods, this translates to about $20 billion in money terms. About $20 billion will come into the country this year through the trade surplus. This is an enormous amount of money for a country this size. And furthermore, in addition to the trade surplus, we also have enormous amounts of money coming in via FDI inflows, which is barely changed this year, declined very small. The remittances from overseas Vietnamese have also been quite robust this year. So when you add up the money from these three buckets, just in cash terms, there's an enormous amount of money that's flowed into Vietnam this year. And as a result, what you can see is that the value of the Vietnam dong has remained very stable this year. The central bank is aggressively accumulating FX reserves. They'll probably have about 5 months worth of reserves by the end of the year, which is also quite an accomplishment. And also, just because there's so much money and so much liquidity in the country, there's been a pretty precipitous fall in interest rates. If you go to deposit your money into a bank, into a savings account at the bank, you'd see that interest rates for savers are down about 1.5 percentage points, 2 percentage points this year. And so, not surprisingly, what's happening increasingly is people are taking their money out of the bank and they're putting it into the stock market and also to some extent into real estate as a result of these lower interest rates. Now, I've belabored this point a little bit about all the cash that's flowing into the country this year. And part of the reason I wanted to belabor this, there's a takeaway here, which is that the remarkable stability of Vietnam's macroeconomy this year, you know, in the face of a terrible COVID recession, worldwide recession, it really is largely because of just all the money that's flowing into the country. So this is an important story for the short term. Now, regarding the long term, there's a growing recognition that COVID has actually improved Vietnam's long-term growth story because it's prompting a new wave of FDI inflows. And you can see on these newspaper clippings I have on this slide, more and more people are picking up on this, recognizing that this is happening. There's many examples that we can point to. The key is that what's driving this is factories are moving out of China and coming to Vietnam. Now, this is a topic that we did an enormous amount of research on. We did a real deep dive on the topic of factories leaving China, coming to Vietnam, also coming to relocating to other countries. We had a lot of engagement in this research with FDI consultants in China. We had a lot of engagement with a group called the Global Supply Chain Institute in the US. We got a lot of great insights from all these people. We produced a 3-part series of reports that you can find on our website, which goes really deep into this topic. The conclusion of this research, the main conclusions, most important conclusion is that there's a consensus that about 20% of the factories in China are going to leave the country over the next 5 to 10 years. Now, this phenomenon of factories leaving China, this had actually been going on for years. Wages in China surged over the last 10 years, and so there was already a phenomenon of factories, including Chinese producers, looking for other places to manufacture their products. And then when the trade war came along, it accelerated the movement of factories out of China. And of course, COVID has just really intensified the urgency for firms that they need to relocate and diversify some of their production. And that's really because there was a lot of firms that they thought that they had a global supply chain. And what COVID showed them is that they didn't have a global supply chain, they had a China supply chain. Now, there's been a lot written on this topic of the over-reliance of firms on China as a supply, as a production base, including in this week's Economist magazine, the week of October 15th. You can find an article on this topic. That article references a survey by McKinsey, and McKinsey found that over 90% of the firms that they surveyed are now taking steps to improve the resilience of their supply chains. So COVID was a real wake-up call for them. Now they see that they need to improve their resilience. And obviously, you can't, one way to improve the resilience of your supply chain is not to have it all in the same country. So these are the factors that are helping prompt a movement of factories diversifying production out of China. But it's not the only factor. I have another point on my slide here, the second point, where you can see this is based on a survey that Bloomberg did, that there's a lot of consumers not so happy to buy products that are made in China anymore. So this is another factor that's prompting firms to relocate out of China. Now, where do these firms want to relocate to? Well, the number one choice, the number one preferred destination is they want to come to Vietnam. And there's a lot of surveys on this from Standard Chartered and others. The number one preference for firms leaving China is they want to come to Vietnam. First and foremost, because wages in Vietnam are anywhere between 1/2 and 2/3 below those in China. And despite the fact that wages are lower, the quality of the workforce in Vietnam is pretty comparable to what you'd find in China. Now, that's according to surveys from Jetro and others. And the other reason why firms would want to locate in Vietnam is because you still have geographic proximity to China, to the existing supply chains in China. China will continue to be the world's manufacturing powerhouse, that's for sure. The next slide is, I believe, the most important slide of this entire presentation. Now, I've mentioned over and over that we have this new wave of FDI coming into Vietnam, prompted by COVID. That's obviously important. That's obviously a great development for Vietnam because FDI has been by far the most important growth driver for Vietnam over those last 20 years. It's created enormous investment opportunities. It's created enormous employment opportunities. It's boosted people's incomes. So it's really been the most important growth driver over the last 20 years. But as important as FDI has been over those last 20 years, going forward, it's been the number one growth driver. Going forward, FDI, the impact of FDI on Vietnam's economy over the next 10 years is going to be even bigger impact than what the FDI flows up until now have been. And the reason why is because FDI companies now see it as being in their own self-interest to build supply chains in Vietnam, to build local supply chains. And here's what I mean. So FDI has been wonderful. It's created a lot of employment opportunities in Vietnam. The reality is that these FDI companies, they don't actually source a lot from local Vietnamese manufacturers. They may buy packaging, cardboard boxes, things of this nature, but the real high value added components that go into making TVs, go into making cell phones, laptops, most of these high value components are still imported. And so what we see starting to happen from now is that FDI companies are now starting to help local Vietnamese manufacturers improve their capability to make these high value components. Because why are they doing that? They're doing it. Why are these FDI companies doing it? They're doing it because they want to source from local firms. And why do they want to source from local firms? Look, it gets back to what I just mentioned before about this urgent need to improve the supply chain resiliency. This survey from McKinsey, over 90% of firms want to improve their resiliency of their supply chain. Well, if you can source from local manufacturers in Vietnam, your supply chain is going to be a lot more resilient. So this is one thing I really want to emphasize here, which is very important, is this phenomenon of the FDI companies helping to build the capability of the local suppliers in Vietnam. This is not unique to Vietnam, and this is not like a new phenomenon. This phenomenon has happened over and over. It's happened in Singapore, it's happened in Mexico and Thailand, a lot of other countries. And the reason that FDI companies helped local suppliers build their capabilities in all these cases in the past, it's not out of benevolence. It's because these multinationals see it as in their own economic self-interest to build the capability of these local firms. So this is what's happening. We did a lot of research on this, and the case of Singapore was really particularly surprising for me. What we found out in our research is that in the early 1980s, when multinational firms started really setting up a lot of factories in Singapore, particularly to manufacture electronics, those multinational companies, they wanted to source from local Singaporean companies. However, and apparently at that time, the capabilities of those local Singaporean companies was terrible. So they couldn't buy anything from them. Now, this is very important because it's quite shocking. For me, we have such an exalted view of Singapore. We think everything in Singapore is so high. But at that time, the capability of these local firms was not high. It was very low. And the reason that I think this is so important is because it shows that one of the keys of how Singapore got from where they were in the 1980s, to where they are now, one of the ways they got up to where they are now in the early days was that multinational companies made an effort to help build up local Singaporean industry. And again, they did it out of their own self-interest. It wasn't out of benevolence. So this is a very important point because this is exactly what is starting to happen now in Vietnam. And this will be the #1 most important growth driver for Vietnam over the next 10 years, this phenomenon, okay? The first prominent example is Apple Computer. Apple Computer is embarking on a multi-year process to help build up a cluster of local suppliers in Vietnam. And that's going to entail things like seconding executives into local firms and to helping these local firms adopt best practices. The important thing here is that apparently this was discussed in a Wall Street Journal article, but apparently all the way back in 2015, Apple Computer, there had already been a lot of internal discussions about the firm's over-reliance on China as a place to produce their products. And I think the important thing here is that they had these discussions for a number of years, And it really was COVID as the catalyst that just prompted Apple to take dramatic action and to go ahead and diversify their production into Vietnam. Apple is a very prominent leading company, so they were already having these discussions, and this is going to be something that's going to lead a lot of other companies to follow on the same path. So these two slides that I just showed you right now, they tell a remarkable, powerful economic story for the next 2 years. So for me, I think these two slides are really the most important slides in the presentation to me as an economist. Now, I hope that for you, the next two slides that I'm going to go over will be the most important slides for you as an investor, because what I'm going to do now is explain how this powerful economic story that's going to drive the country's growth for the next 10 years, how this translates into investment opportunities and how you can make money off of that. There's two key points I want you to take away here. And the first is that most investors don't really, have not really fully understood the importance of this high value added FDI story, FDI 2.0 story, if you want to call it that. And because most investors have not recognized, that this is the path the country is on, that really means there's an opportunity for people who, can take advantage of this before the rest of the market sort of understands how important and how powerful the story is. So that's the first key takeaway. And the second key takeaway is that this next wave of FDI into Vietnam is going to accelerate the emerging middle class story. Now, it's relatively easy to see and anticipate what comes next for Vietnam's middle class because we can look at the example of China. Now, in China, when China was at a similar stage in its development as where Vietnam is right now, when China was at a comparable stage, it hit a kind of inflection point. And once it pushed through this inflection point, over the next 10 years, and this is around $3,000 GDP per capita, which is where we're close to where Vietnam is now. So once China pushed through this inflection point, over the next 10 years, people's income in China soared threefold. Real estate prices soared threefold. The stock market surged. People's income was a lot higher, so they were saving a lot more money, and they had more money to put into the stock market, propelled stock prices higher. So all this unfolded after China passed this kind of exactly where Vietnam is today. So China was in the same position about around 20 years ago. And once China pushed through this, you had 10 years of amazing growth. This whole topic about the inflection point, and it's happened in China, it's also happened in other emerging markets. This could be the topic for a whole nother presentation, a whole nother set of research. So I won't get into all the details, but the key that you need to know is Vietnam is right now is in kind of the same position that China was in. And once China managed to push through, things really, the domestic economy really accelerated for the next 10 years. And so we think that this next wave of FDI, this will be the factor that pushes Vietnam past this inflection point, and then you see, just a surge in the growth of everything over those next 10 years. So I think this is what's coming for the country. I want to end my presentation by just briefly coming back to the topic I mentioned in passing, because I think it's so important. This idea that the market has really not caught on to how important and powerful this FDI story is, and that like Singapore, these multinational firms are going to help accelerate the growth of Vietnam. I don't see a lot of people talking about this. Certainly when Apple announced that they were going to bring some more FDI into the country this year, of course that was big news, but nobody discussed what I regard as the more important part of that news, which is this other really important development that Apple is going to help build out the local industry in Vietnam. This is not something that the market has picked up on yet. So what I predict is, especially over the next year, as this story begins to become more widely understood by the market, you see more articles about this in the Wall Street Journal and the Financial Times, this is going to be a catalyst that prompts inflows into the stock market here. I'd like to just remind any of you that happen to join my previous investor conferences or read my work or the work of my colleagues, we're often ahead of the curve on these kind of things. You may recall at last year's conference, I think we were the first ones to really talk about the idea that the US-China trade war would benefit Vietnam. A year ago, we were the first ones to talk about the idea that the value of the Vietnam dong is about to start appreciating next year. Now you see others coming around to that point of view, Goldman Sachs, Standard Chartered, and others. And there's a lot of other examples where we've been ahead of the curve. The reason I'm reminding you of that is really in the hope that you can recognize that this is an opportunity that not a lot of people have picked up on the market. And this is a chance to benefit from this before other people. Now, how would you benefit? Well, there's a lot of obvious beneficiaries of this whole FDI story. For one thing, if people's incomes are going to surge threefold over the next 10 years, then obviously any companies that are selling products to emerging middle class consumers, they're going to do great. And there's also a lot of other obvious beneficiaries. There's going to be more industrialization. The country will need more infrastructure, more logistics, more anything that involves industrialization is going to go up. Also, there's indirect beneficiaries, what people might call second derivative plays. So, if there's going to be a lot more industrialization, the country will need more electricity. If people get more wealthy, then they're going to want to spend more on healthcare, for example. So, this topic about where to invest, it's really more for my colleagues, my investment colleagues. But I wanted to highlight a few kind of obvious beneficiaries. But again, the main point, the main takeaway that I hope that you'll get out of this is that this phenomenon, which is obviously coming, it's very easy to see that this is coming, but yet most of the market doesn't really, recognize the importance of this story yet. This is a big opportunity, and we really hope that you'll be able to take advantage of that opportunity before other people, recognize that. So this is my presentation. I really want to thank you for your time today. And what we're going to do next is I'm going to get out of the way, and we're going to set up for the next Q&A segment. So thank you for your time.
Now we've got the table and chairs set up. So Michael, thank you very much for your comments, and we'll get to our Q&A in a quick second. Just want to address a couple of comments that have come in during the session. A couple of folks had mentioned that the slides are blurry. We apologize. Zoom 2020 is a new world. We will be uploading the presentation on our website, VinaCapital.com, and so we will have that for you at the end of the session. And then if you do want to ask questions to Michael right now, the chat function is working on Zoom, so please ask a question if you'd like. With that, Michael, I'll just ask you a question that came in earlier. And this actually is kind of a question for Dev from HSBC, but we don't have him here live, so we'll just go to you. In Dev's comments, he expressed concern about Vietnam's ability to absorb FDI, and you spoke about FDI significantly. Is that a realistic concern? And how do you feel about that?
Yeah, that's a great question. This is actually something we did a lot of research on a year ago. The issue first came up when the trade war started accelerating between the U.S. and China, and that's when you first started having a big acceleration of factories relocating to China. So we did a real deep dive into this. You can find that, by the way, that research paper, by the way, on our website if you're interested in the details. The summary was that when you really look into the details, we have probably about 5 years worth of logistics capacity worth of industrial land. There's actually a lot of agricultural land up in the north in Vietnam, and also to some extent in the south, rubber plantations that can be converted. I thought Dov made an excellent point in his presentation that I haven't seen other people make before, which is that you will probably see more industrial activity go out further out into the cities. I think Dev is the only one I've heard mention that. And then regarding the workforce, surprisingly, about 45% of Vietnam's workforce is still employed in agriculture. So there's a concept in economics called the Lewis turning point, which is basically when you run out of people to come from the farm to the factory. China probably passed its Lewis turning point around 2014, 15. Vietnam still has lots and lots of workers that can come to the factory. So I think it'll be at least 5 years before this really becomes a serious bottleneck.
Okay, excellent. And then a question came in from Philippa earlier in the session. Can you comment on Vietnam's relationship with the U.S. and how that might affect trade? And so I guess I'll add a follow-up to that, which is I think a week ago or a week and a half ago, there was noise about the U.S. putting the Vietnam dong in a kind of a currency manipulation watch list or investigation. So kind of add that to the question.
Yeah, well, these two are really intertwined, right. So that's a good point. The U.S. Trade Representative, the USTR, launched a Section 301 investigation into Vietnam at the beginning of October. And what this investigation is really focused on is trying to ascertain if Vietnam is artificially depressing the value of the dong to accelerate its exports. Obviously, if a country's currency is artificially low, then it means the price of its products is also going to be cheap. So that would boost your exports. Now, this caught a lot of press because this same mechanism, the Section 301 mechanism, is what the U.S. used as a mechanism to impose tariffs on China. So that did get a lot of press attention. That having been said, actually, there was almost no reaction in the stock market. The dong had almost no reaction to that. And I think that's because most people, like myself, believe that there's really no realistic possibility that there'll be draconian tariffs on Vietnam. In my case, I believe that for two reasons. One is because of the geopolitical issues, and also because actually the merits of the argument that Vietnam has been depressing the currency are not really there. So just hasn't been happening.
So let's follow up on that. So for foreign investors, currency does matter. And so what is your view on the dong kind of the remainder of the year and kind of 2021, Section 301 or not, kind of what's your view on the currency?
Well, one of the reasons that this Section 301 investigation came up is because there's such a large trade surplus with the U.S. And before COVID, I think the intention of the government was to try to reduce its surplus with the U.S. by buying more airplanes, by importing LNG. And the first option is not really realistic now. They will eventually import LNG, but that takes a few years to happen. So realistically, what you'll probably see is that the policymakers let the currency appreciate.
Okay, so you're actually forecasting in an environment where we're actually going to have rates come down here, interest rates come down, right. Currency will actually appreciate as well.
That's right. I mean, the rationale, when we first started talking about this a year ago, and as I mentioned in my presentation, you see a lot of other people coming around to this view now. The rationale for expecting that the dong is going to appreciate is because Vietnam is really following in very, very similar footsteps as China. So China, around 2006, China's currency started appreciating, went for about 7 years, it went up about 25%. If you look at what happened in Vietnam over the last 10 years, we've almost followed one for one in terms of the amount of FX reserves, trade surplus, this kind of stuff. So that will be the motivation.
So let me pivot here. So a question just came in from Shang, who's asking, when will Vietnam reach the inflection point of $3,000 GDP per capita? 10 years, 15 years, 20 years. And then, it's interesting. I'll ask you a little caveat to that, which is, what's the view of that number in urban areas versus rural areas?
Yeah, good point.
It's a leading question, Chung, so I'm helping you out there.
Yeah, so very good point. And one of the reasons why I probably had some real urgency feeling in my presentation is because it's not in 10 years, it's like next year. So this whole process of us pushing through this inflection point, it really starts kind of now. And that's why I probably had so much urgency. The other point you made is really good. The urban income is probably around in the high 5,000s, maybe almost 6,000 per capita. So,
yeah, and I think for those of you that have visited Ho Chi Minh City before or Hanoi, you know, it's understating the amount of new wealth that's being created here every day, whether it's, you know, retail malls or other places. So I just think for those of you who can see what we see, 3,000 was passed quite a long time ago. You know, happily, we didn't talk about COVID that much, but I'll bring it up here. Because the government and society handled COVID so well, there hasn't been the need for as much of a fiscal response from the government, certainly relative to other countries. Do you think there will be? Does there need to be? And if there isn't, are there other ways that the government's focusing on stimulating the economy?
Well, when you look across emerging markets, on average, EM countries spent around about 3% of GDP to help their economies get through COVID. To put that number in context, in the developed world, it's about 10% of GDP. So those countries obviously are richer; they can spend more. So 3% is the average across EM. Vietnam's fiscal stimulus to address COVID was about 2%, a little bit over 2% of GDP. And actually, out of that 2% figure, if you look into the details, it entailed, payments to individuals, payments to households, tax cuts. The amounts that were paid to people are pretty comparable to the rest of the region. If you look in the Philippines, Thailand, I mean, adjusted by the cost of living. Sure. So it was a pretty comparable stimulus, but less than half of the money was actually dispersed to people. And that partially, that's a reflection of how robust the domestic economy is. It's also a reflection of the fact that the kind of administrative aspects of actually getting the money into people's hands. There were some bottlenecks there. So the government's talking about a follow-up package. It will probably end up being around $1 billion. And the key of the follow-up is it will be a little bit easier to get the money into the hands of people. So that's what we expect. Yeah.
Interesting. Now, in terms of any kind of large projects, as you think about things that are less almost consumer-oriented, more commercial-oriented, is the government doing anything there?
Well, there is a big focus on infrastructure development. This year, infrastructure development is up about 40%. And in fact, if you look down the line items of all the items in the GDP, construction, I think, is the only thing that's actually higher this year than last year. Last year at this time of the year, construction was growing at about a 5% pace. This year, it's a little bit faster, around 8%. So that's probably added about a quarter to the GDP growth this year, and it's helped offset. Some of the private sector construction is less commercial, less residential, and then the government has sort of taken up the slack. So that's helped to support the economy. And probably more importantly, gets back to the first question we were talking about, is it really lays the ground to increase the capacity for FDI inflows to come in the long term.
So, a fair amount has been written, and if you, read about Vietnam, it's always about the growth story, which is good. Now, a potential issue of growth story is a shortage of various supplies or things that are needed for that growth, particularly energy. Is this leading to energy development, which ties into the infrastructure story, and then will it be in time? Meaning, where's the demand-supply imbalance? Is it here already?
Right.
And if so, what are we doing about it?
Yeah. Well, in the 10 years that I've been here, there's been this constant, they're always kind of trailing each other. Sometimes it's a little bit behind, sometimes a little bit ahead. On average, over the last 10 years, both supply and demand have grown about 9% a year. And the demand is a little bit faster. So in the time that I've been here, there's certainly been times where they needed to import electricity. The government just came out with a new 5-year plan. And of course, it calls for much more capacity. The other thing it calls for, by the way, is it's a bit of a quirk, but there's more supply in the north because there's more hydro, and in the south the demand has been growing faster with industrial activity. So there'll be some more transmission between the north and the south. But there's also something very important in the next plan, which is that right now coal and hydro are both almost 40%, both. So coal is almost 40%, hydro is almost 40%. And the plan had been to aggressively ramp up coal, electricity generation from coal. And of course now with global warming, there's a lot of concern about that. And so the plan now is to, going forward, to shrink coal to probably a little bit below 30%. And there's gonna be a lot more emphasis on natural gas, and that it's cleaner. And it also addresses the other issue of, if we import a lot of LNG from the US, that will help to shrink the trade balance. So that's something that's good. Our firm is involved in that. There's also been a lot of rooftop solar that's been going on. It's another thing that we've been involved in. So it's good for both the country and for us as a firm.
So you'll see not only energy development, but a fair amount of clean energy development as well.
Yeah.
Interesting. A couple of more questions have come in. Another one from Philippa, so we'll go here. Does Cambodia represent competition to Vietnam, albeit they are a number of years behind?
That's a really great question. And that actually ties into a couple of different things, because there was a lot of legacy in investment, and I mentioned it in my presentation as well, into garments and footwears, and this is sort of 15, 20 years ago. Well, now, and Dev and Joseph mentioned this in their presentation as well, we're transitioning to high-tech products.
Yeah.
So now about a third of Vietnam's exports are high-tech items. Mm-hmm. So we're kind of happy to see some of those lower value-added things, transition to places like Bangladesh and Cambodia, and we'll focus on the more high value-added items.
So what's happening is shoes and clothes are moving there, and we're getting Panasonic, which is moving their I think it was their refrigerators from Thailand, and Samsung's moving.
Yeah, and when you think about it, the future of the country, when and this is every other Asian tiger economy, they took electronics and they built out a whole supply chain around that. If you've got garments, there's not a lot of places to go from that. So, but with electronics, you really have a path to high value, much more high value added economy. And that's where we're going.
Yeah, so I would say not really competition. It's more about taking the, I suppose, supply of manufacturing that we're graduating out of.
Yeah, exactly. Yeah.
Okay, interesting. A question just came in about, and I'm not sure this goes to you, but I'll ask you anyway.
Sure.
What are the latest thoughts on when FOL, which is foreign ownership limits, will be addressed?
Okay, my own personal view. Now, I'm currently the chief economist, but I had jobs in the past where I was the head of equity research. So I do have some thoughts about this.
Are they consistent with others at our firm?
I believe so.
Okay.
But I have an economist kind of spin on that. So I mentioned that there's been an increase in infrastructure development. Now, hear me out. Now, what I think what we're going to see, it will be kind of like a dominoes thing where we need more infrastructure development. We need more money to pay for that. That's going to drive privatization, and that's going to be the thing that really helps the foreign ownership limit get higher, particularly in the banking sector.
And a question that frequently is kind of a follow-up on that is, the transition from frontier to emerging markets. Yeah. And is that predicated on dealing with some of the FOL issues?
The FOL is the only real issue. I mean, as far as I'm concerned, there's other technicalities.
Right, but so,
it's the only real
so in order to get, and that'll drive more liquidity into the markets as well.
Yeah,
so if FOL is addressed, me, you think it goes from frontier to emerging?
Yeah, and to be clear, it's not if, it's when. It will be, it'll absolutely have to be addressed.
Yeah, I agree. Another question just came in. Let's see here, a couple. Does increased automation affect the attractiveness of low-wage workers in factories?
So this, what people are calling the 4IR, Fourth Industrial Revolution story, I think this is a little bit of a non-issue for countries like Vietnam. This is a topic that we actually wrote a research paper you can find on our website. Let me give you the synopsis of that research, which is that A.T. Kearney and a few other people have looked into this. And the reality is that for dexterity type things like doing garments or doing certain kind of electronics production, the economics of mechanizing it versus paying low-wage workers, it doesn't add up. And so the most obvious example is for garments. I mean, even though I just mentioned we're kind of graduating out of garments, this is the most easy example to see. You can get a robot, which is called Sobot. You can get a Sobot that produces garments. It's 17 times more productive than a worker. You say, wow, 17 times. Well, the problem is the salary of the Sobot operator is like 20 times a worker. And so that doesn't even include the machinery. So that's a stark example, but the same type of example applies.
I mean, we're seeing, you know, if you look at the VinFast factory, you're seeing you're seeing in autos and in higher value items, you know, you're seeing definite automation, robotics, but in kind of other things.
Yeah, it doesn't make sense.
It's not going to replace it. Okay.
And by the way, this is A.T. Kearney saying this. Okay. A.T. Kearney had a report where they said the reshoring of low value added component is just not going to happen.
Another question came in, government privatizations, is this hype or a real story? And I'll put a note there. Is your answer different today than it was, say, in 2017, 2018?
No, it really ties back to what I just mentioned before. And I know it seems a bit disjointed what I'm mentioning right now, but if you want to know what's going on with privatization, look at infrastructure. Because this country has, I estimate we probably have around 45% of GDP worth of readily sellable stuff that can be used to pay for infrastructure. So when you see the infrastructure story take off, that's going to be the thing that really drives the need to privatize.
And do you see, unfair question for you, but what the heck, is there a timeline on that? I mean, and I don't think anybody wins with this question, so forgive me for putting it in a spot, but.
Right. Well, it's great because all these things are sort of tying together. And to get back to the very first question from HSBC, I think we have about 5 years before we run out of capacity to absorb a lot more FDI. So the government's very smart. They understand this. They have a lot of very smart technocrats. And so that's one of the reasons why you see them really starting to ramp up infrastructure.
So would you think 2 or 3 years you'd see more privatizations?
I think so, yeah, I think so.
Next year or 2, 3, 4 years?
I don't think next year. I think the world will still be recovering from COVID, but I think it will be from the 2 to 3 year type point. Yeah. Okay. And also, by the way, for the banking sector, this is something I think Dev mentioned in passing. The banking sector needs capital as well to grow. So that will also tie into this story.
Well, terrific. Now I have some closing comments, but is there anything you'd like to say as we end up here?
I think the only thing I wanted to just recap very briefly, because we also had the question about the U.S.-Vietnam relations, is there is one topic that's a bit important to keep in mind, is that the geopolitical importance of Vietnam to the U.S. You know, when you look in this region, almost every other country in the region has, to some degree or other, pivoted away from the U.S. and basically towards China. China and the U.S. are trapped in what people are calling a Thucydides trap, you know, which is when you have a dominant power and an upcoming power, there's always some tension and conflict. So Vietnam it turns out, is a very important ally for the U.S. The people in Vietnam have, when you take surveys, we have the highest view of, I mean, a little bit ironically, people in the U.S. have the very highest opinion view of the U.S. in the world. So this is turned out to be a very important ally for the U.S. And so I think that's an important point that people need to know.
Terrific. So that kind of concludes the formal remarks. Michael, thank you so much. I'd just like to remind everybody 2 quick things. Number one, we'll be putting a recording of this entire session on our website, VinaCapital.com. So if you want to take a look at the slides a little bit more closely, if you know of a colleague that wanted to join but couldn't, please share it with them. And then next week, we'll be having a session at 3 p.m. Vietnam time as well. We'll be focusing on the Vena Capital Vietnam Opportunity Fund, which you may know as VOF. And then 2 Thursdays from now, we'll have another session. And then finally, on November 5th, our 4th session. So in a world of a continuous Zoom webinar, we hope this 90-minute forum and format has been successful. Thank you so much for your time and look forward to seeing you next week. Thank you.